All right, why don't we get started? So thank you guys for joining. My name is Mark Lamonica. I look after the individual investor team from Morningstar here in Sydney. And today we're going to talk about our global best ideas. We'll pull out a couple names that we'll go through. But first, anything you hear today is general advice. I don't know anything about you, so I obviously cannot offer personal advice. If you are in New Zealand, you can go to our website, morningstar.com.au, get a copy of our FAP. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you are looking for personal advice. Okay, so a couple things. Let's get into the deck. Best ideas. That's a very creative title. But we do have an upcoming series of webinars. So this is the schedule. We've got a Tuesday series and a Thursday series. If anyone wants to sign up for any of these, or has any other questions or comments, you can email me at mark.lamonica1@morningstar.com. All right, so what are we looking at today? We are looking at our Global Best Ideas report, and as I said, we'll go into some detail on 3 different names, but just so everyone knows what this is, to provide a little bit of context. So Morningstar has analysts here in Sydney, equity analysts here in Sydney, in Asia, in North America, and in Europe. And on a monthly basis, they sit down and out of the roughly 1,600 global shares that they cover, they can come up with a list of their best ideas. And that is what we're going to look at today. So just so people can find this, we'll quickly go to the website. We go into Discover Investments, security type. It is right here. So this gets updated on probably the 2nd and 3rd of every month. So a new one does come out every month. So you can see that in our May version, which came out in the 1st of May, we have 82 different names. And as I said, they are around the world alphabetically. Australia does come first. So you can check out the Australian ones. And basically, there's a short write-up on each one of these, and they can go read the full research report if you want. So that is Global Best Ideas. But as I said, we are going to explore a couple of the names. I will say, to pat myself on the back, I'm doing a very good job of navigating the different screens today. Emily, who's in the room, does not seem impressed, but she should be. All right, so we're going to talk a little bit about our ratings first, and we'll go through some examples. AGL will not be an example, although they have been in the news lately. So we look at a couple different things. Our analysts look at a couple different things here. So number one, we look at fair value, and we'll get into the star rating in a second. So what is the fair value? That represents what our analysts believe the share is worth. So they use a discounted cash flow model to do that. So basically, they are projecting out future cash flows, and they are discounting them back to the future, discounted cash flow. And they're discounting back by the weighted average cost of capital. So basically, what the company pays to source funds, whether they are raising funds by issuing more shares, equity financing, or debt, borrowing the money. So that is what our analysts do. What we then do is we compare that fair value to what the share is actually trading for. Right? Because we want to calculate this fair value independently of what's happening in the market, because we want to evaluate if a share is undervalued, fairly valued, or overvalued. Based on that, this comparison between the fair value and the last close, and taking into account a margin of safety, meaning that we want to account for the fact that the future is unknowable, account for any projection mistakes that are made. We want a margin of safety before we buy. That translates into a star rating. 5-star stocks being the cheapest stocks, the biggest discount to fair value, given that risk and margin of safety. 1-star stocks being the most overvalued. A couple other things we look at is moat. We'll talk about moat today. Moat is a sustainable competitive advantage, popularized by Buffett, and really refers to the ability of a company to withstand competition and market forces, which are trying to, of course, drive down returns that the company is going to get. So wide moat, narrow moat. Wide moat is 20 years. We believe they have a sustainable competitive advantage that lasts for 20 years or more. 10 years for narrow moat, and then most companies have no moat. So those are some of our ratings. We also look at capital allocation. So of course, one of the biggest jobs by any company is, or one of their biggest responsibilities is to allocate ultimately your capital if you're a shareholder. Should they invest in the business? Should they pay you dividends? Should they buy back shares? Should they pay down debt? Should they go buy other companies? Are they making good decisions there? So just a little context to what we're going into today. Yes, okay, so we've got some chat. So thank you, Phil. I am sounding better. My COVID recovery hopefully is complete, at least for a little while, until I'm sure I'll get it again. All right, so we're gonna cover 3 different shares today, but I do wanna provide a little context. So number 1, when we are looking at shares, when our analysts are going in and evaluating things, we need to think about what the consensus is for the market consensus for these different companies that we're covering. And really, when we start thinking about investing in shares and we have an opinion that's different than the market, that can be our opportunity, right? So there are, of course, future scenarios that are priced into shares, priced into the market as a whole, future scenarios for how a company will perform, and then how, of course, the economy will perform and everything else. So what are we really looking for? We're looking for views, or we have a different view than the consensus. And that is where you can get into opportunities where a share could be undervalued or overvalued. That what the market thinks is going to happen, we disagree with. So that's really what you need to think about as an investor, right? If something is, of course, fairly valued, then in your opinion, what the market is forecasting to happen will just happen. And remember that investing is about expectations and differences between what actually happens and those expectations changing over time. That is investing. So that's one piece of context. The other piece, of course, is that there are 82 names on that list, but all of us have different objectives from an investment standpoint. And so, of course, there are different shares that work for different people. Number 1, because of your objectives. Number 2, also just because what you are comfortable with, right? As investors, we want to stay invested for the long term. So there are many different strategies out there. We want to pick a strategy that we are actually comfortable with. If it resonates with us, that means we are more likely to stick with it, which is very important. All right, so 3 companies we're going to cover. So we're going to do KOGAN, we're going to do Anheuser-Busch InBev, so a global share, and then we're going to do Westpac. So I try to pick a diverse selection. So we do have 2 Aussie shares, 1 global share. They're all in very different businesses, and they all basically are different types of companies and different types of shares that may be appropriate for different people. So let's go through these. Okay, so let's start. And one other thing, we have 2 special reports related to 2 of the shares that we're going into. So in KOGAN, we have something called KOGAN's Best Bargain, Maybe Its Own Shares. So that's a comprehensive report that our analysts have come up with. And when we get onto Westpac, we have a report on all the banks saying, farewell cheap loans, banks, shareholders, and depositors cheer on rate rises. So that's really looking at the net interest margin of Australian banks. So it's something that a report came out on the 30th of March. So if anyone wants a copy of either one of those reports, you can email me and ask me for them. So if you're interested in going a little deeper, we do not have a special report on Anheuser-Busch InBev, but anyway, you're probably more interested in the Aussie shares. So let's talk about what's going on with KOGAN. So as you can see, it is trading at a significant discount to our fair value. So we believe that the company is worth $11.70. And this was, I think, on Monday that we pulled this. It's trading at $4.87. So you can see that is, and you can see 58% discount. So that is big. So let's talk a little bit about this share. So that does equate to a 5-star stock. I will say that our uncertainty rating is high. So an uncertainty rating is looking at how confident our analysts are in projecting out the future. So remember, there are some industries and companies that it's pretty easy to forecast out what's going to happen to them. They could be big established companies. They could be selling a relatively inelastic good. So an example is maybe potentially consumer goods. At the end of the day, Coca-Cola is probably not going to double their sales next year. They're probably not going to have their sales drop in half next year. So think about the uncertainty rating and think about how you invest and what is comfortable for you. So I would certainly put this in the speculative category. In terms of the type of investment. So that's what we were talking about earlier, that there are different types of shares that work for different people. But let's start going through this. So there's a couple things that have happened, and we need to go back a little bit historically and talk about consensus with KOGAN. So as you all remember, we had this whole COVID thing. A lot of retail went online and sales, of course, soared because none of us could go to stores. So we were ordering things online. So one of the big beneficiaries there was KOGAN, and the share price ran up significantly. And the price to earnings ratio went up to 265 during COVID. We, of course, thought that at the time it was very overvalued, and people were just sort of playing this COVID trade. Okay, well, and this is sort of this first order thinking that we try to get beyond at Morningstar, that we can't go shopping, so we're going to order stuff online. And we always saw this, of course, as temporary. And I think it is obviously proven to be temporary as we've all emerged back into the world. So there was this huge run up in KOGAN, and since, of course, it has done a lot worse as those huge gains that they had, the huge revenue gains they had, disappeared. Now, we have a little bit of a different opinion. So we think a couple things. We think, number one, that COVID was an opportunity where there was an acceleration of an ongoing trend of more retail going online, more retail dollars being spent online. So we do think that that will continue, that trend. The spike that we saw in COVID, obviously we thought was unsustainable and would come back down as stores opened up. So, we thought that the market got way ahead of itself, and KOGAN was extremely overvalued, according to our analysts. And of course, now at this point, we think that the sell-off has been too pronounced. But a couple things have happened that shareholders do not like. So one thing is management decided to suspend dividends. So obviously, we all like dividends, especially in Australia. So this was not something that the market reacted well to. And there's also been more spending by the company. So we've seen profit margins come down in KOGAN. So especially what they've done is they have spent a lot of money on marketing. We think that this is a temporary spike. We think that reinvesting the money from the dividend back in the business is something that we think will earn a return that's higher than its cost of capital, which means it's a good thing for the company. So we do think that this is temporary. But a couple things to think about. Number one, we do not assign KOGAN an economic moat. And this is when we want to start thinking about, when we're thinking about competitive advantages, we want to think about the industry that the company operates in, and what are the influences in that industry. So one thing, of course, about retailing online or regular is that you have a lot of choices. So of course, they are selling other brands. You can go buy things that you can buy in KOGAN and all sorts of other places. And there is a lot of competition. There are very low consumer switching costs, and price is normally the driver of where you're going to go out and actually shop. And there is a lot of competition. So there's competition certainly from Amazon. So Amazon is expanding its presence in Australia. There's competition from omni-channel retailers. So remember, KOGAN's all online. We do have a lot of retailers that have both online sales and actual brick and mortar stores. click and collect. You can do things like that. So that's basically omni-channel. And so we do not think that KOGAN has an economic moat. Now, Amazon, for example, we do think has an economic moat. You hear a lot of those comparisons. Now, Amazon's relatively new still in Australia, but obviously if you go to the US, and I was just back there a couple of weeks ago, and surprisingly, Amazon's got its own planes now and delivery trucks. So it is interesting how much Amazon has grown even since I've been in the US. But we think that Amazon actually does have a moat. Number one, because of AWS. So a little bit different than what KOGAN does. That, of course, is Amazon Web Services, cloud computing. But we also think they have a moat because of their customer loyalty program. So basically Amazon Prime. And we think that that is something that does keep people going back. And of course, we think that Amazon has a huge cost advantage. So at this point, once again, we do not see an economic moat for KOGAN. And that does, again, put it on the speculative side. But obviously still on our best ideas list because of this huge discount. And, at the end of the day, what we think is that things are going to continue to get better. We think that they have a lot of inventory, so they probably spent too much running up their inventory, but we think as they unwind that bloated inventory and scale back marketing, as we were talking about, we think that by 2024, they're going to have a very different cost basis, and that they are going to drive their margin up, and that could be potentially the catalyst for the share to take off. So we do have that report. If you do want a full-scale report and we'll read our research report in total that's on our website. But if you do want that special report, also, you can send me an email and I will get that to you. So Johannes, who's our analyst in Sydney that covers it, does think very highly of KOGAN. So something to look out for. So did want to show one thing, sort of the history of this share, or of this share price. So what you can see is, going back at this point to a 5-year period, you saw this huge COVID run up. Right, and once again, that is when people were simply buying this because brick and mortar stores were closed. And if you look at our price to fair value, you can see that during this period in 2020, we thought the share price was very overvalued. It, of course, came back to earth, as we can see, and this is sort of this discount we see here. So we think that this sell-off was obviously way more than it should be. And this, once again, is expectations, right? The expectations of people that were buying here were that this huge surge of sales that occurred during COVID would continue forever. Then, of course, when that didn't happen, when the company faced some margin pressure with this expanded marketing spending, this huge sell-off was a result of that. And we think at this point, the market expectations are way too low, and that we'll start to see improvements. All right. So Brian says that he's been a fan of theirs for a while, and he says his family uses their website all the time. Okay, so that is an endorsement, I guess. All right, so Henry's saying, is it good to keep this stock on my portfolio since I already lost 40%? Well, okay, so this is obviously a question that a lot of people have: when to sell. And Henry, I'm not necessarily sure that you did this in the first place, but question that, or something that we always encourage people to do, is to write down the reasons that you're actually buying a share. What is your thesis? So I don't think a 40% loss, while steep, and while I'm sure you're not pleased about that, is necessarily a reason to sell. But the question is, what is your thesis about KOGAN? Why are you buying this share? So for instance, you can go through and read what our analysts, that I summarized today, what our analyst thesis is. And that will give you an opportunity to take a step back and say, does this still make sense? Do I still think, if you're our analyst, do I still think that the COVID period accelerated the adoption of online retail, and that you're going to continue to see overall market share of retail that's purchase online increase, while our analyst thinks that we will continue to see that trend. Do we think KOGAN's going to be a winner in that? Our analysts clearly think so. Do we see some catalysts to, once again, as investors, what do we want? We want our companies to keep more of the money for that margin improvement. We'll talk a lot about margin when we get to Westpac. Do we see that happening? Well, our analyst says yes. So the question is, that is his thesis. What was your thesis for originally buying the share? So I think price movements, and while I understand that price movements are something that drive a lot of activity, that's not necessarily a reason to buy or sell something. So I think that is how I would go about it, Henry, and sort of what and how it fits into your thesis. Somebody wrote something nice to us, Shani, who I know is listening. Genevieve said she likes our podcast. It was her gateway drug into investment podcasts. We were very into gateway drugs here, right, Emily? Emily's looking at me like I'm crazy. But thank you for that. Thank you for that message. That was very nice. Yeah, so Genevieve is saying KOGAN's on her watch list, would like to see a bit of a recovery before buying, don't want to try to catch a falling knife. So maybe we should take a second sort of talking about what's happening in markets. We actually just recorded a podcast episode talking about what's happening. But yeah, obviously there is a lot of volatility. I did see a couple of people writing that KOGAN's now at $3.50. You know, what we've seen, if you step back and sort of look at what's happened in markets overall, and Australia has been insulated from this to a certain degree, but what we've seen is a lot of the more speculative names have sold off significantly. And I don't have the stat in front of me, but we talked about it on the podcast. If you go and look at the NASDAQ, which is the more speculative names in the US, a lot of technology shares, basically we've seen this enormous sell-off in a good deal of the shares that are on NASDAQ, like really shocking losses. And really the market is kind of repricing risk right now. So, you know, I think you are going to see, like with a company like KOGAN, you are potentially going to see a lot of volatility. So it is something to remember. What our analyst does think is that the fundamentals of the company will improve over time, as I sort of discussed. And, you know, that will eventually drive share prices higher. But yeah, right now is obviously I know a scary time for a lot of people. As I said, we fared a little better in Australia, certainly, than the US. But there's a lot going on right now. But remember all this stuff that we're hearing about. So if we go back and we look at the market, and this is kind of the point we're making on our podcast, if we go back and we look at the market, the expectations were way too high. So investors' expectations on future returns, the expectations around the economy, basically the expectations of what was going to happen as we came out of COVID were really, really high. And it was very difficult with high expectations for reality to meet those. We'll start to think about what's happening now. And this is in no way saying go out and buy shares now because they're still expensive. But if you look at expectations now, the expectations for inflation and rising interest rates and the fact that rising interest rates are going to push the economy into recession, there's a lot of very negative expectations. So remember, as people become more pessimistic, and I don't think we're there yet, but as people become more pessimistic, then we start to get a situation where reality could potentially very easily surpass those really pessimistic expectations. So just something to think about. Yeah, so John's saying Amazon is $1 trillion. So I think we're looking at market cap versus KOGAN, 360 million, different leagues. Absolutely. And I think, you know, that's reflected in our moat rating. So Lisa's saying tech sell-offs have really impacted some ETFs on the local market. Yeah, so obviously as an Australian, two things have happened as Australian investors. If you look at sort of where the market is, you know, after last night, the S&P 500 in the US this year is down around 18%. The NASDAQ is 28, 29% year to date, and Australia's around 8, so probably a little more than 8. So that was sort of my point, that the Australian market in general has done better. The other thing that's really helped Aussie investors is the Aussie dollar. So, well, the US dollar has done very well. So the Aussie dollar, haven't seen where it is today, but earlier this week it had broken 70, and so it was something like 69 cents. And so that insulates you from losses if you are investing in the US. So as Australian investors investing overseas, we want the Australian dollar to get weaker. That adds to our returns, or in this case, what it does is makes our negative returns less negative. So that's sort of what I was talking about in terms of being insulated. But the same things have happened. Like there's been tech sell-offs in Australia, but tech shares make up a lot less of the index than they do in the US. Yeah, so John saying gambling versus investing. Yeah, I mean, listen, I would certainly say that taking on more risk, being more speculative, played out for a while and made people a lot of money. And, as I say, the chickens are coming home to roost now. So, I think shares without fundamentals, as I said, especially shares that don't make money, are doing really poorly. What's actually doing pretty decently? Large dividend-paying, somewhat boring companies. So, yeah, it's a good point. As Genevieve saying, blood not flowing on the streets quite yet. Yeah, agreed. All right. So, 69.19. I assume, John, that you were just telling me what the Aussie dollar to US dollars. So I'm really looking forward to getting my credit card for my recent credit card statement for my recent trip to the US. I'm sure everything got a lot more expensive. All right, let's see if we have any other questions. I will get to those. All right, let's move on to our second one. We're going to talk about Anheuser-Busch InBev. So full disclosure, I actually own this. I've owned this for a while. So let's talk a little bit about this company. So number one, what do? They sell beer. So they are the world's largest brewer by a lot. And a couple different things we should think about. Number one, let's think about this industry and let's think about brewing beer. So despite the fact, and we'll talk about craft beer in a second, despite the fact that we all like our craft beers and think that they're made by some guy with a beard in his garage, brewing is about scale. So it is relatively, at the end of the day, beer is kind of a commodity, right? This is not wine. We're not out there worried about the particular place that we're growing our grapes. So in beer's case, we are buying bulk commodities to brew wine. To brew beer. It's a pretty simple recipe at the end of the day, right? We've got some grains, we got some hops, we got some water. So what that means is that scale is really, really important. So manufacturing anything that's kind of like a commodity, scale is really important. But scale is very important regionally. So global scale, not so much. Regional scale, really important, and something that Anheuser-Busch InBev definitely has. So we'll talk a little bit about the business, but a couple other things to look at. So once again, you can see our fair value. In this case, we have a medium uncertainty level. So once again, uncertainty looks at when our analysts are estimating out those future cash flows, how sure are they of this? So why would this be lower than a company like KOGAN, for example? Well, this is a giant, huge global leader. Now, that can be a good and a bad thing, but at the end of the day, they're selling beer in a lot of different markets. They have a lot of different brands. They have a lot of scale that we're not going to see giant increases or decreases in revenue, for example. It's going to be relatively easy to predict beer sales going forward. So they also, as a large company, they have financial resources that KOGAN certainly does not have. They serve lots of different markets. So if the economy isn't doing well in parts of the world, they're still selling in other parts of the world. KOGAN sells in Australia. Australian economy matters for them. So all I'm saying is that a lot of times with big companies, a lot of times with, goods like beer, where The economy goes up, the economy goes down, people are going to keep drinking. A lot of times with companies like this, you're going to get lower uncertainty. Now, that lower uncertainty probably means that there's less upside, right? But just something to think about. The other thing, of course, we have here is economic moat. We'll spend some time talking about economic moat, but we believe that they have a wide moat. And we believe they have a wide moat for two different reasons, which we'll discuss: cost advantages and intangible assets. So let's talk a little bit about the company. So the company bought, so at the end of the day, Anheuser-Busch InBev has acquired a lot of different brewers around the world. So Anheuser-Busch was an independent company, as was InBev. They bought SAB Miller. So SAB Miller is South African breweries. So they went into a lot of debt to purchase this company, and they've had a hard time paying that off. So it's one of the reasons why the market in general, the market consensus, is not very high on Anheuser-Busch InBev. So they bought this company. The plan, they always said that they were going to pay off this debt. They cut their dividends so they could direct more of their cash flow into paying off the debt. And then, of course, COVID happened. So COVID, of course, impacted sales with hospitality being closed off. And so they have struggled to pay off their debt. Now, this sort of pandemic-related sell-off of the shares, we think, was an overreaction. We think the market is too concerned about the financial risk with the company from all this debt. And we do think that they will be able to slowly pay this off. And once again, we do think that they have built this great business. So talk a little bit about this wide moat. So in certain areas, and I've got it somewhere in here. So in certain areas around the world, they have an incredible amount of market share. So particularly in Africa and in South America. So South America, they've got 75% of the beer sales in Colombia and Ecuador, 73% in Bolivia, 60% in Uruguay, 65% in El Salvador and Peru. So that's what we're talking about in terms of regional dominance. Same thing in Africa. So there's 7 different countries in Africa where they have 50% or more of market share. And what that allows them to do, it allows them to take advantage of these 2 different drivers of their wide moat. So number one, we talked about beer. We talked about that it's a scale business. When you're in a scale business, cost advantage matters, and you get cost advantages from scale. Because they are by far the world's largest brewer, when they're going out there and negotiating with people to buy the raw materials that go into beer, they of course have a very strong negotiating stance. They are able to go out there, and everything that gets produced into beer, they're able to go out there and get it cheaper. Their larger scale production facilities also have other cost advantages. So their biggest contributor to their wide moat is this cost advantage. And, a couple of the things that our analyst points out looks at some of the margins that they're actually getting in certain markets. So 40% plus EBIT margin, so that's earnings before interest and taxes in South America. So that is incredible. So what that means is of every dollar that they sell, they get to keep more. And why do they get to keep more? Because they're able to produce the beer for less. The other thing is intangible assets. So intangible assets basically refers to, when we think about tangible assets, that's something that's on the balance sheet, right? That's like a building. So as an example, if you're Qantas, it's a plane. It's an asset of the company that they use to generate revenue. Intangible assets are things that are not on the balance sheet. So a big one, and what we're talking about here, is brand. So of course, these huge market shares that they have, that I was talking about in South America and Africa in particular, these of course are brands. That's how many people go out there and buy beer and everything else, right? You walk up to the pub, you see a bunch of different beers they offer, there's a brand that you know and you order. So we think that that is a contributor to their moat, but not as much, of course, as cost advantage. And one of the things around brands that we've certainly seen here every time we go to the pub or a liquor store is they, of course, are facing particularly in North America with their Budweiser and Bud Light brand, they are facing a lot of competition from craft brewers. So all the time you're seeing all these little regional craft brewers pop up, and they are taking market share away. So that's really why we have this limited degree for intangible assets. So yeah, what's the story at the end of the day? Well, the story is we think the company's going through a bit of a transition, that they're going to need to pay off this debt, and that paying off this debt has slowed due to COVID, but now that things are opening back up, we do believe that they should be able to do that. And we think as that financial risk that the company has, as that moderates, as they're paying down that debt, we think that the market will start to recognize the strength of the company they've built and the strength of the company they built through this large-scale acquisition. And we did have a question about KOGAN and sort of what our analysts think about the company and think about management. Well, a lot of what you see there is in this capital allocation. So exemplary for Anheuser-Busch InBev, same thing for KOGAN, exemplary. So that is really what we think about management. So if we think about one of management's biggest jobs, it is to allocate capital. Now, that does not necessarily mean that you're going to like the decisions they make as an investor. For example, with KOGAN, they cut their dividend. Well, they suspended their dividend so that they could invest in the business. Shareholders don't like it. Anheuser-Busch InBev did the same thing. Actually, before COVID, they cut their dividend so that they could pay off debt. It didn't really work out that way, right? Because COVID happened and revenues dropped. But those are not generally popular moves with shareholders for very valid reasons, but can pay off if, in KOGAN's case, reinvesting the business allows them to grow. In Anheuser-Busch InBev's case, if cutting the dividend allows them to pay back debt. So just something to think about. And really, you can read our capital allocation decision where we talk about sort of the quality of management. And what I will say is a lot of the management is out of Brazil here, and they do have a reputation and history of really wringing costs out of businesses and becoming a lot more efficient. So there are some detractors from that, but at the end of the day, our analyst thinks that that's what they're doing with SAB Miller, which they purchased, and will pay off. All right, we've got some questions. We'll do some questions, then we'll get to Westpac, which people are probably very interested in. All right, so Lisa says, will rising inflation have a negative impact on the local and global discretionary retail goods stock sector? Okay, so let's talk a little bit about inflation. So what we're really worried about with inflation, there's a lot of things we're worried about with inflation, but what we're looking for in companies is, do they have the ability to pass on the price increases that they are getting into, in this case, ingredients that go into beer, cost pressures they're getting, are they able to pass that on with price increases? And if you go and read the latest note we had from our analyst, he talked about their recent earnings and talked about, yes, there are very good signs that they are passing on that inflation to consumers, and that it isn't really impacting demand. So, at the end of the day, with consumer staples, Lisa, and we'll consider beer a consumer staple, people are probably going to cut back, particularly if rising interest rates impacts the economy. People are going to look for ways to cut back. The question is, what are they not going to cut back on? Traditionally, people have not cut back on alcohol. They found other ways in their budget to save. But yeah, we can see there. And so you asked about the discretionary retail. So yeah, discretionary, and I don't know if, Lisa, you're saying beer is discretionary or not. We would consider it more of a consumer staple. But yeah, that's probably where you're going to see in true discretionary spending is a place where you could see a big impact from, number one, the economy slowing, and then also inflation. And we talked a little bit about, might as well do it now. We talked a little bit about Australia, and we'll get into this with Westpac. But this is where it's interesting to sit there and look at the makeups of different markets. So I talked about the US, that we've seen this huge sell-off. A lot of it, if we look at index levels, a lot of that has been driven by this tech sell-off. because, and we talked about this multiple times on here, because tech made up so much of the US index. Well, in Australia, we have a very different profile, right? The indexes in Australia are dominated by banks and they're dominated by resource companies. So the question is, of course, what is going to happen with the economy? Because both of those sectors are in what we would consider cyclical sectors, meaning they will follow the fortunes of the economy. So it'll be interesting to see what happens, because that's where we could start to see hits in Australia. That if the economy goes south, you're going to see a lot of those cyclical companies not do great. And Westpac CEO actually was talking about this when they released earnings this week. Let's see what else we have here. Okay, so Graham, Phil's making fun of me for drinking a lot of beer. You've never seen me drink a beer, right, Emily? No, she has never seen that. So Graham is saying more explanation how the changes of currency rates affects overseas investments would be great. Okay, so let's talk about this for a second. So when you are investing overseas, so whether you are buying a fund or an ETF or buying an individual share, so if you wanted to buy Anheuser-Busch InBev, what would you do? So you would open up an account that has overseas trading, and you would take your Australian dollars and you would buy, in this case, because it trades in New York, you would buy US dollars and buy the share. And then, of course, the share is going to bounce around in price over time. Then, if you want to sell and get your money back, you are taking, in this case, US dollars, and you're buying Australian dollars. So, if we think about that scenario, what do we want between those two periods of time? When you buy and when you sell, we want the Australian dollar to get weaker. Because if it's stronger at the beginning, I'm buying more US dollars, and it's getting weaker. That means when I'm translating those US dollars back to Australian dollars, I'm getting even more Australian dollars. So as overseas investors, wherever we're investing, we want the Aussie dollar to get weaker. Think about it, it's the opposite of if you travel, right? So at the end of the day, what do you want if you're traveling? If you're going to the US, you want the Aussie dollar to be really strong, all right? So that you are able to go out and things will be cheaper in the US if the Aussie dollar is really strong. We want the opposite to happen if we're investors. So hopefully that explained it a little bit, Graham. There are, if you're investing in funds and ETFs, a lot of them have hedged versions. So they can actually remove that currency risk. So you'll see it. You can go in there, look at different ETFs. You'll see some that say hedged. That means they're taking that currency risk away. So go, an interesting experiment, go and look at the returns of a hedged version and an unhedged version. Some periods when that Aussie dollar is backing off, you are going to have, well, depending upon where returns go, since they've been negative, they will fall in less for the ones that do not have a hedge. So the unhedged version will fall less than the hedged version. So hopefully that helped. Yeah, and Eric made a good point. Yeah, dividends. So think about every time you get a dividend paid, you're moving that back in Australia. That also helps. All right, let's see what else we have. Sorry. Yep, Bernard's talking about hedge. Do alcoholic beverage company fit ESG criteria, wondering about product safety? Okay, that's a really good question. ESG. So let's talk a little bit. We'll spend a minute on ESG, and then we got to get to Westpac. So yeah, ESG, of course, we're looking at environmental, social, and governance factors. There's a lot of interesting things being said about ESG. There are, of course, ESG funds and ETFs. And in those cases, you need to go and look and see what their exclusion criteria is. So could alcoholic beverages not be in those funds and ETFs? Of course, depending upon what their exclusion criteria is. But you get to make your own decisions. And I always think that ESG is a pretty personal thing. So as I said, I do own Anheuser-Busch InBev. I drink. I see no reason why I should not own a company that produces alcohol. That is a personal view. I think ESG is probably a lot more personal than it's made out to be. And I think with a lot of some of these direct indexing products that are starting to come out, which basically means that you can almost create your own index. You can go in and pick and choose different sectors and different companies you want in and out. I think people will then have an easier time creating a portfolio, especially using products like ETFs, creating a portfolio that actually reflects their values and not the values that have kind of been imposed by some ESG companies. So maybe that's me on my soapbox a little bit about ESG. But yeah, that's my ESG answer. Okay, let's talk about Westpac. So as you guys know, and first of all, let's talk about banks in general. So what are some of the things that we're looking at with banks? Well, the big thing that I alluded to earlier is we're looking at something called net interest margin. So net interest margin basically, and you think about the business of a bank, and they do various things, but it's basically saying what is the amount of money that a bank is earning lending it out, right? So what is the interest rate that borrowers are paying versus what is the interest that the bank has to pay to get those funds to lend out? And that can be either through taking deposits from people. So what are they paying you in your transaction accounts? Basically nothing. What are they paying for you in savings accounts, term deposits, or when they're going out and accessing those funds from the wholesale market? What are they paying for those? So that's why we always are very, very we look at the net interest margin every time we look at a bank. And one of the interesting things is generally banks do well in rising interest rate environments. And the reason they do that is because in many cases there is a mismatch between when a bank will raise, and I know that this is always controversial in the press, when a bank will raise with interest rates going up, when they will start adjusting all of the interest they require from borrowers versus when do they actually pay their depositors higher interest. Well, they're all generally pretty quick to raise the amount that a loan's going to cost, and a lot slower to raise the amount that they are going to pay people that deposit there. So banks generally do well in rising interest rates environments. There is one caveat to that. And the caveat is that banks generally do not do well if the economy doesn't do well. And that's for two different reasons. So one reason, number one, is obviously as economic growth slows, loan volumes slow. So they would not do great in that scenario. And the other thing, of course, is the chance of bad debts goes up. The economy isn't doing as well. People are going to have trouble paying off all the loans that they took out. So that's the interesting thing where we are with banks right now. So obvious interest rates are going up. The question and sort of the fear out there is, will interest rates go up enough to crater the economy, and what impact would that have on banks? So that's kind of where we are with banks. But let's talk about Westpac. So Westpac reported results this week, I believe. So our analyst put up a new note. So one thing he wasn't really thrilled about is their home loan book remains stagnant, was the word that he described for Westpac. But everything else he thought was going a lot better. So he called the results marginally better than what he thought, but he saw strength in business lending. He saw strength in the net interest margin. So once again, how much they're making off of their loans versus the costs. So a lot of the pressure that it was under, and we saw CBA report today, and they talked about how there's too much competition in loans, basically saying that the price is too good, the interest rate is too low on a lot of loans. He thought credit quality was great, thought the balance sheet was strong. He saw reduction in operating expenses. So basically at the end of the day, he was pretty pleased with what happened. He actually increased his profit forecast by 4%. And the dividend of 61 cents was higher than he thought. And he revised up his dividend forecast 4% as well. So in 2022, he saw $1.25. So yeah, pretty decent results according to our analysts. But what has happened with Westpac? Well, at the end of the day, Westpac is the only bank that, in our opinion, is undervalued. So if you look at the other big four and Macquarie, this is the only one that we think is undervalued. And we think it has a wide moat. We think all the banks have a wide moat. And really, in Australia, if you look at the banking market, the funding advantages, basically the ability to go out there and source cheap funds for the big four banks, is a lot stronger than a lot of the smaller regional banks. So that's why they all have wide moats. So yeah, Westpac, I wanted to put a bank on here just because I think it is an interesting time to start thinking about banks, thinking about what the impact is going to be of rising interest rates. For many companies, of course, the impact is negative. For Westpac and some of the other banks, we think it actually could be positive, depending upon, of course, central banks' ability to not sink the economy in the process. All right, we've got some more questions on here. Yeah, so Jeff's saying, can you provide a list of wide moat stocks that will do better under the developed Aussie and US market conditions? Well, listen, I can talk, Jeff, about sort of what has happened. As I said, a lot of the more speculative names out there have sold off. A lot of these are companies, frankly, without moats. What has done pretty decently is sort of resource shares until recently, but sort of large dividend paying wide moat shares. Things around sort of in the consumer staple category, perhaps healthcare, a lot of this sort of non-cyclical sectors. So we talked about how Australian market is dominated by a lot of those cyclical sectors that will get impacted based on how the economy does. If you sort of look at non-cyclical sectors, so healthcare, for example, consumer staples, so all this stuff where basically, you're probably going to go get your prescription filled no matter what's happening with the economy. You need to feed your family no matter what's happening with the economy. I think those are some of the names that have actually done pretty decently lately. Obviously, I have no idea what will happen in the future. But once again, I think it's really looking at expectations, overall market expectations, and figuring out, do you think that the market's too pessimistic? At this point, sort of the scenarios, and we've seen this over time, right? We kept hearing from central banks they weren't raising interest rates for years, and Australia was the holdout. Much after pretty much every other central bank admitted that interest rates were going to start to go up, and we started to see more inflation, Australia was the holdout. But then we started seeing, and we're talking about these expectations changing, then central banks started saying they were raising interest rates. Everyone thought inflation was transitory. Now people are starting to say maybe it's not transitory because it's been around for a while. So we're just starting to see all these expectations change. And I think they're still all going negative. But at a certain point, it will be so pessimistic about what's going to happen in the future. Maybe that then is an opportunity for a surprise on the positive side. All right, so Phil would be interested in an international best idea. So one thing I would say, Phil, is we can do a webinar on that, but they are still all, now of course, I remember I was bragging about how good, here we are. Yeah, they are still all on this list. So I did mention that Australia was at the top, but simply keep going down. Sorry, I've got a lot of screens open. Yeah, keep loading more, and then you start getting into all the others. So obviously they are in alphabetical order by country. So you have to go to the bottom if you want to start getting the US, for example. But yeah, you can see all 82 of them. And then also, since people seem to like to print stuff out, you can simply download a copy as well. And what that will give you, I need to log in. Anyway, that'll give you a PDF. And then you can print out the copy. And if anyone happens to be going to the Australian Shareholders Association conference in 2 weeks, I will be there with Shawnee, and we're going to print out some of these. So you can come pick up our Global Equity Best Ideas there. All right, so we seem to be out of questions and almost out of time. If anyone has any questions, if you'd like those two reports, just email me at mark.lamonica1@morningstar.com. I'll send you a PDF of those reports. And hopefully you attend some of our upcoming sessions. So thank you guys very much.
Any advice in this video is general advice. or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.